This clip is really a continuation of the earlier clip on accounting principles, and I'll jump straight into the sixth one. The sixth principle relates to the accounting period, and this principle entails that a business has to complete the whole accounting process over a specific operating time period. Now, when we do financial statements, we do them on an annual basis. But you can have accounting periods which are either monthly or quarterly or even half yearly, as long as you disclose that. You have to be transparent in terms of what the accounting period is. The seventh principle relates to conservatism. And this states that given two options in the amount of business transactions, the amount recorded or the value recorded should be the conservative one. It should be the lower one as opposed to the higher one. The eighth principle relates to consistency, and this principle really says you have to treat things consistently. You have to treat them in the same way. You have to report them and capture them in the same way year in, year out, so that people can compare. And because there's consistency, people will be able to do comparisons of the financial information over a number of years. The ninth principle really talks to materiality, and it basically says what is the size of the transaction that will affect the decision making of a user of the financial statements. How big does a mistake have to be before it changes quantitatively and qualitatively what someone going through those financial statements is going to interpret from the information that they have in front of them? That is materiality. The 10th principle speaks to objectivity, and that simply says we must capture all the information, record all the transactions that have taken place in a way that is independent. It is objective. It is free from bias or influence and prejudice. And the 11th principle talks to the accrual basis of accounting. And that simply says all transactions, be they revenue, expenditure, assets or liabilities, all transactions should be recorded in the annual financial statements, even if cash hasn't exchanged hands, even if the documentation has not been finalized. These are core principles that speak to the collation of transactions in the accounting records and also the compilation of the annual financial statements.